Hey everyone, this is Robert with Gold Silver Pros, and for today's video I wanted to talk to you about the benefits of owning physical gold versus owning the derivatives and physical silver as well. A lot of people like to invest in these derivative investments, different funds, the GLD, the SLV, and I think that there is an advantage to owning the physical silver that we will get into. I wanted to refer back to a previous video interview that I did with Nick Bearshift of BMG Group, where he outlined some of the risks of investing in the GLD and SLV specifically for gold and silver. Please refer back to that for some research on the risk in investing in those particular funds, which I won't go into detail here. But I did want to compare the returns of gold and silver to those funds as well as to some other mining indexes. So let's get started. I will share this presentation or share these screenshots here. Let me get this full screen for you guys. We're going to go full screen mode. Okay, here we go. So I'm going to bring this down just a little bit. Here we go. So here we have GLD, which is the SPDR Gold Shares Fund, which is what a lot of people invest in when they think they're investing in quote unquote gold. As compared to the price of gold from 05 to 20, so about 15-year period of time, you can see that the GLD has returned less than just investing in the physical precious metal, as the chart has been trending down pretty much the entire time. While there have been some spikes up and down, for the most part, the trend line is decidedly down. And why you see this down trend line is because the GLD is a derivative investment, and there are fund expenses for investing in the GLD, which is why you're never going to get the return over the long term that you will in holding the physical precious metal. One other thing I wanted to point out is that if you own a substantial amount of physical precious metal, yes, there are storage fees if you choose to store that in a safe vault, such as at a Brinks facility or other facilities through one of these reputable storage companies, such as BMG or many, many others. You can go to Gold Money, you can go to silverbullion.com.sg. You can, I mean, there are a lot of routes that you can go. There are a lot of people that have legitimate storage options for you. But storing physical gold in those facilities is often really cheap. And when you compare the costs of trading the GLD, your brokerage costs, and the management fees, I think you'll find that owning gold is not quite as expensive as you think it would be. And in addition, if you own shares of the GLD, you can't redeem those shares for the gold. Only the authorized participants can do that, and you can read the perspective, and it's very clear on that, so you don't have exposure to the real metal. Also, something I wanted to point out with a lot of these derivative investments is you can short them. And in the shorting process, your broker will borrow shares from somebody else in their portfolio of investors that have, say, GLD shares, and they'll loan them to you for purpose of shorting them. That means that all the shares in the market aren't backed then by the gold in the fund. So if there are a lot of shorts, that means there's a lot more share exposure than there is gold in the fund. And it also tends to suppress the price. Again, why you see this downward trend in the GLD. So I wanted to move on, and I wanted to talk about the GDM, which is the NYSE ARCA Gold Miners Index. This is a popular gold miners index. And if we graph this since its inception, 1994, to now, which would be about 26 years, you can see that if you own this gold miners index, you lost money. It was down to 0.54, meaning you lost a substantial amount of your investment by holding this index. Now, certainly there are times at which it did very well. It's over a factor of 1, especially between 1994 and 2007. But when you see real serious financial crashes, such as the Great Recession, 2008, 2009, you see the real value of gold come through over that of the indexes of the miners. You'll see this throughout some of the different indexes we see in the miners as well. So there are individual mining companies which could be beneficial to own, which offer really good quality leverage to the gold price. Same thing goes with silver as well, but you have to be really careful in picking those. When you're picking up one of these indexes, you're getting an amalgamation of different companies, and you're taking on basically the market risk of a large group of miners in the market to beating the returns on gold itself. And as you can see from this index, the GDM has not kept up. I want to now talk about the GDX, which is the Van Eck Vectors Gold Miners ETF. And you can see, again, downward trend line as compared to the price of gold, this time since about July of '06. So yeah, you're not getting the returns in the Van Eck Vectors Gold Miners ETF as well. So you're going to see this time and time again with a lot of these ETFs or these index funds, that you're not getting the return on these miners when you're taking a large swath of miners into account into your portfolio. So essentially what you have to do if you want to buy the miners is you have to beat the market to get a higher return in the miners than you would just by owning the precious metal itself. And certainly a lot of people do this. And if you feel very confident in grading out the miners and picking the winners and taking all your risks into account, then that's fine. A lot of people can't do that. And that's why you have these index funds in place, but the index funds don't have the return of just simply owning the precious metals to begin with. Here we want to look at the GDXJ, which is the juniors version of the Van Eck Gold Miners ETF. And again, you can see a downward trending line. And in this case, it really hasn't recovered since October 11th, when you had the gold price up around $1,900. And this is consistent with some other research I've done in terms of investment into the junior mining index space. I recently did a presentation for O&M Partners in which I outlined some data from my friend Kai Hoffman, who owns Orin Inc., and he tracks Canadian junior mining investment. And the junior mining investment looks almost identical to this performance chart of the junior gold miners, meaning the money has not been coming into the space to fund the junior mining investments. Of course, then it makes sense that the shares would trade at a discount because they're not getting the funds to develop their properties since 2011 and the high in the gold price. Who knows when that will change, but until that funding changes and they're able to finish their exploration and maybe sell these economic deposits to bigger miners to go ahead and produce or become a miner in and of themselves, we wouldn't expect this index to increase over time. We would consider to expect it to sideways trade or come down like it has since 2011. Now we wanted to look at the HUI, which is the gold bug index on the NYSE. And you can see that for a while it did pretty well. It did well up until the financial crisis, although there was a major dip in 2001. So the thing about the HUI is it really accurately follows the general economy and recessions. You see that we had a recession right here in 2000 timeframe, 1999 through 2000, 2001. We had a recession here in 2008, 2009, and the HUI doesn't do well during recessions. So those gold mining companies don't tend to do well, even in a rising gold price environment, because between 2009 and 2011, gold reached its all-time highs, both in trading volume from a lot of aspects and also in price. And yet you see the HUI underperforming the gold price there. So if you had owned this index as sort of a proxy for getting access to some of the miners, you would not have gotten the returns. Had you simply just went to your local store and purchased some physical bullion or purchased it online at a reputable depository that would store it for you with appropriate security and audits. So again, the HUI can be good to own at certain periods of time. You definitely can see from 2001 to about 2004, even though across 2007 it did quite well. And it didn't quite do as well as gold, but it did well, but it just doesn't have the returns of the physical metal. Here I wanted to outline sort of an exception to this rule when dealing with ETFs. The US Global Go Gold and Precious Metals Miners ETF has done pretty well when compared with gold. I mean, it kind of keeps up with the price of gold, and it sometimes trades to a bit of a premium. You see a big dip here in March of 2020. So when there was a lot of panic due to COVID, this index sort of fell off the bottom. I would guess, probably educated guess, that there were liquidations in this fund to pay for expenses and to pay for, to deal with certain risk factors in businesses and accredited investors and hedge fund managers trying to cover losses across their portfolio. So you will see a dip like this when there's a big market scare, and that's something to be considered. This fund hasn't really been out as long as some of the other funds. You can see we've got data from July 2017. So we really don't know how it's going to act during a large recession like we had in 2008 or in 2000, like we can see with the HUI. The HUI, we've got more data, and we can see that it drops and it follows the recessionary trend. We don't know what it's going to be for in the US Global Go Gold and Precious Miners ETF. Certainly the performance since July of 2017 has been pretty good, just not quite enough track record there. So I would put this definitely on your watch list. If you want to invest in that, that's okay. Just understand the risk that you're taking and investing in this fund. that looking at the other minor indexes, there's a higher probability chance that you're not going to be able to keep up with the gold price one for one. So it still may be better to own gold, but at least from the recent data, this one's doing a little bit better than some of the others. And I wanted to look at the Direxion Daily Gold Miners Index Bull 2X shares. So this is one of those leverage index fund in which you get 2X the performance of gold supposedly. But you can see that this really has taken a beating since 2011 when the gold price was at its high, of course. To be fair, that's when the gold price was at its high, but the gold price has not fallen as much as this fund. And you can see that you're getting probably more than 2 times the loss in this leveraged fund that you would in the gold price. So again, you have to be really careful with these leveraged funds, and they may leverage up 2 to 3 times either short or long of the actual commodity daily trading price. A lot of times those perform worse than the commodity, even to the upside. And even with the recovery, I would say in late 2018, we had a recovery in the gold price from about 1190 to now up around the 1750 range, where it's been trading the last couple of weeks, or actually a month. And even in that time frame, you can see that the NUGT has just been flatline compared to gold. So it has not had anywhere near the performance that gold has had in that time frame. So again, you're taking risk when you invest in some of these ETFs or index funds. Now, I wanted to change gears and talk a little bit about silver. Certainly, silver is another precious metals that a lot of people are interested in. It's a much, much smaller market than gold, but it has more of an industrial component. So silver is traded more industrially. It's used in solar panels and the green movement. It's used in electronics and iPhones and Android phones. I mean, it's used in a wide array of things. Most of the technology we have today could not exist without silver. It's also used in medicine, and it has a monetary component because silver has been used as some form of money for over 6,000 years, actually a bit longer than gold. But in recent times, due to its lower price than gold and some other metals as well, and its very unique properties, it gets gobbled up for industrial use. So, but a lot of people like to invest in silver, and you can see that the SLV, which is iShares Silver Trust, is not performing as well since about July of 06 that silver is actually in the market. A lot of people believe that the actual spot price of silver is suppressed because most of the last 10 years, with some exceptions, 2016 and around the 29 to 2011 timeframe, it's actually traded below the price of the primary silver miners can get it out of the ground. And there are reasons for that, but essentially it's been the actual spot price of silver or daily price of silver has been below its actual cost to get out of the ground. So it's like you being able to go and buy milk at the grocery market for less than what it costs the farmer or rancher to get it to the store, all costs included, or getting a discount to the actual manufacturer cost of a popular vehicle, such as like the Ford F-150, getting $600 to $1,000 off of the manufacturer's actual real cost. That's what you've been able to do with silver for most of the last 10 years, with some exceptions. But even given those circumstances, the physical precious metal has outperformed SLV. And again, that goes back to the GLD argument with gold. There are management fees here, plus you can short the shares. And when you can do that, there's going to be more downside to those funds. And of course, you can't, as a retail participant, participate in redeeming or having access to the actual physical precious metal. Only the authorized participants can do that. That's in the prospectus. So again, not a whole lot of reason to own SLV versus silver. Certainly a lot of people do. The only reason I can see why you would want to own SLV or GLD is if you want very short-term price exposure to the gold and silver market without taking possession of the metal. And that's certainly fine if you want to do that, but you have to account in your trading fees as well. Depending on how much you want. If you want a little bit of exposure, you could actually go buy the physical product and sell it back. Again, there's going to be the spread between the bid and the ask of your local dealer or at MEX or wherever you get it. If you're doing it in any volume, I see why people go to GLD or SLV, but that's very short-term investment. By the time you add fees to that, it's still usually not great from a performance perspective, especially in silver, since silver has been trading relatively flatly since 2016 in this narrow range between 14 and 17 bucks. I also wanted to look at the Global X Silver Miners ETF. So this is a popular ETF. It's been doing okay when compared with the silver price. Certainly it bottomed in 2016 when silver was trading about 20 bucks. It's actually come up and at the end of 2016 kind of reflected some of silver's rise, and then it's come back down and back up. This is not a horrible investment in silver. Some of the silver miners have done okay. Certainly you have your big ones like Fresnillo and Pan American and First Majestic, and you have a bunch more coming on board like First Majestic and Silvercrest. that have good silver resources in high quality jurisdictions. So certainly there are a lot of good silver companies out there. But again, owning this index didn't really give you a whole lot of advantage because you're spreading your risk across a bunch of silver miners, and there aren't that many. So there's probably less of a distribution of risk in silver than there is in gold, owning the miners. But still, there is some. And so sometimes it's easier just to own the physical precious metal, unless you feel like you know the silver companies very well and you've done your research and you think you can outperform and gain that leverage of the stock that stocks will offer you to the actual silver price. And certainly if you think you can do that, go ahead. But it's not without risk. And certainly, any individual company presents a lot of portfolio risk if you're just investing in one or two, unless you really know what you're doing. I wanted to show you here the Pure Funds ISE Junior Silver ETF. So now we're looking at the junior silver miners. You can see there's a lot more volatility in 2016. When silver price shot up, you see this momentous jump in the SILJ index. A close analogy to this would be a company like Impact Silver that I cover quite a bit. They're the most pure of the junior silver miners because they have over 90% of their income is directly from silver, a little bit from gold and zinc and some other components, but almost all silver. And so they really jump when the silver price goes up. So when you see the silver price, jumping up to $20 an ounce, this index does well. So does Impact Silver, ISVLF on the Toronto Venture Stock Exchange. But you're also averaging in some of the other juniors and they don't perform as well. So we can see since 16, it's kind of been this downward trend, this even trend since about 18. Even though the silver price has gone up, the silver shares haven't really beat the silver price when it went up from 14 bucks. Or actually, I think it got down to like 11 bucks or something insane momentarily up until its current price of around high 17s dollars an ounce. These indexes have not beat that. So again, looking at these, there's not great performance of these various derivative investments to the actual components themselves. Simply, a lot of times it's easier just to go buy physical gold, go buy physical silver, and you'll get better performance, even if you're having to pay somebody to store it for you. You could go to a Gold Money. They have really inexpensive storage, and they audited every year. They have great ownership rules and never had any fraud that I'm aware of. You could go to like silverbullion.com.sg. You can go to BMG Group. You can go to AppMex, I think, has a silver storage. I mean, I'm not trying to advocate any company. There are tons of companies out there actually that offer allocated storage. It's audited. You have direct access to the metal, cheap fees, and it's insurance. They have insurance and bonding. Those are the things you want to look at where you can actually get to the physical. That offers you safety and security, relatively low fees, but good protections. That's really what you want to look for. And you can purchase this at any amount you want. You can purchase as little as $500 in many cases and go up to $1 million if you can find it now. Now, in this current market, gold and silver have been somewhat in a shortage. So if you needed to buy $1 million of either or both, it may be hard to source that right away because there have been supply chain shortages due to COVID, shutting down some of the refineries and the mints. Some of those are starting to come back on. You're seeing it start to come back online. The miners in Mexico, you're starting to see some of the refineries and mints coming back online in the US and in Europe as well. So you're starting to see supplies come back to the market, but there is a higher premium and finding a lot of it can be tough. But again, even that given the case, that's a short-term phenomenon. I expect in the long-term ownership of the physical precious metals to be better than some of these indexes. And I think the data is very clear. So going back to the miners for a moment, certainly don't want to disparage you getting involved in the miners, but I would pick your targets. I would do your research. I would look at the best quality mining companies. Number one is management. Number two is deposit. Number three is jurisdiction. And there are other factors as well. Certainly, I have a learning series on this on my website, goldsilverpros.com, if you want to know more about how to appropriately value miners. But I would look for high quality mining targets. I wouldn't necessarily invest in the indexes because you're taking on some of the lower quality ones. And as you can see in those charts, it really does downgrade your returns in that market versus just owning the physical precious metal. This has been Robert with Gold Silver Pros. Appreciate you guys joining me. Until next time.